Banking Lesson 2, Checking Accounts versus Savings Accounts. In this lesson, we'll be going over the difference between checking accounts and savings accounts. We'll also be going over the benefits and uses for both types of accounts. Checking accounts are used for day-to-day spending. The money in these accounts are like a revolving door. Money comes in and money goes out. When you use your debit card to pay a bill, you have proof it was paid compared to if you paid with cash and you lost the receipt. Checking accounts typically have a monthly fee. Some banks have a special criteria to waive those fees, and some banks don't have a fee at all. Common fee waivers are for high school students, military, and senior citizens. Direct deposit is a feature that allows your employer to direct deposit your paycheck into your account. Some other entities, like the IRS, use direct deposit for your tax refund. Banks prefer you to set direct deposit with them and will often waive your monthly account fees for doing so. You can check your bank information online by downloading the bank's app. These methods allow you to track your every transaction that goes in and out of your account. You can transfer money, pay your bills, set up automatic savings, and deposit checks. Speaking of checks, most people don't even use them anymore. And if for some reason you do need to write a check, we've included a PDF in the download section that shows you what information goes where when you're filling one out. Rather than buying an entire checkbook, you can usually get a few free checks from your bank each month. ATM cards only get money from an ATM. Even though it looks just like a debit card, they do not work the same. Debit cards also allow you to make ATM withdrawals. They enable you to make purchases virtually anywhere by using your PIN. You can also use a debit card for online shopping. Debit cards are not to be confused with credit cards because they're entirely different. Debit cards are available on all checking accounts to people as young as 13. With a credit card, you have to be at least 21 years old or 18 years old with a cosigner. A debit card doesn't cost you anything to use because it's your own money. While with credit cards, you're borrowing money and you get charged interest on any unpaid balances. Debit cards are going to require a PIN, while a credit card usually requires a signature. Debit cards do not build credit history, while credit cards build credit history. A lot of banks charge a monthly fee for each savings account. Make sure you look for ones that don't charge a fee. You don't want to pay money for an account that you're using to save money. Some banks require a minimum balance kept in savings, and if you go below that balance, you might have to pay a fee depending on your bank. Savings accounts are designed to have a limited number of withdrawals each month. If you go over that minimum number, you will typically have to pay a fee. If you go over that specific number of withdrawals too many times, the bank will automatically convert your savings account into a checking account. Savings accounts earn interest. Some offer better interest rates than others, but a good rule of thumb is to only use a savings account to save up for short to medium length goals. Savings accounts should not be used for investments. So now you understand why using a bank is important, the difference between banks and credit unions, and the different purposes of a checking and savings account. In the download section, we've also included a checking versus savings account comparison chart. In the next lesson, we're going to explain the different types of interest, how inflation affects your money, and why that matters to you.